Hi everyone, welcome to another video from Rookie Investor. In today's video, we will talk about mutual funds, what they are, their types, benefits and risks, key factor to focus on, and how to invest in them. So, what are mutual funds and how do they work? Mutual funds are investment strategies that allow you to pool your money together with other investors to purchase a collection of stocks, bonds, or other securities that might be difficult to recreate on your own. This is often referred to as a portfolio. Mutual funds are operated by professional money managers who allocate the fund's asset and attempt to produce capital gains or income for the fund's investors. To note here that the fund managers responsible for the fund, sometimes called its investment advisor, are legally obligated to work in the best interest of mutual fund shareholders. A mutual fund's portfolio is structured and maintained to match the investment objectives stated in its prospectus. Mutual funds give investors access to professionally managed portfolios of equities, bonds, and other securities. Each shareholder therefore participates proportionally in the gains or losses of the fund. As mentioned, the funds invest in a vast number of securities and their performance is usually tracked as the change in the total market cap of the funds. Most mutual funds are part of larger investment companies such as Fidelity Investments, Vanguard, and Oppenheimer. Now that you're aware of what a mutual fund is, it is time we talk about how they receive their market value. The value of the mutual fund depends on the performance of the securities in which it invests. When buying a unit or share of a mutual fund, an investor is buying the performance of its portfolio, or more precisely, a part of the portfolio's value. Keep in mind that investing in a share of a mutual fund is different from investing in shares of a stock. Unlike stocks, mutual fund shares do not give the holders any voting rights. A share of a mutual fund represents investments in many different stocks or other securities. The price of a mutual fund share is referred to as the net asset value per share, sometimes expressed as NAV or NAV-PS. A fund's NAV is derived by dividing the total value of the securities in the portfolio by the total amount of shares outstanding. Outstanding shares are those held by all shareholders, institutional investors, and company officers or insiders. Mutual fund shares can typically be purchased or redeemed at the fund's current NAV, which doesn't fluctuate during market hours but is settled at the end of each trading day. The price of a mutual fund is also updated when the NAV-PS is settled. So, why do people buy mutual funds? Well, they have a few perks that make them appealing to them. Those are advanced portfolio management. When you buy a mutual fund, you pay a management fee as a part of your expense ratio, which is used to hire a professional portfolio manager who buys and sells stocks, bonds, and so on. For many people, this is considered a relatively small price to pay for getting professional help in the management of an investment portfolio. This could be a good perk for new investors that don't understand how the market works or how to invest themselves. Second, dividend reinvestment. As dividends and other interest income sources are declared for the fund, they can be used to purchase additional shares in the mutual fund, therefore helping your investment grow. Third, risk reduction. Reduced portfolio risk is achieved through the use of diversification, as most mutual funds will invest anywhere from 50 to 200 different securities depending on the focus. A lot of stock index mutual funds own 1,000 or more individual stock positions. This allows investors to be well diversified, investing at the same time in different stocks and sectors. Fourth and last, convenience and fair pricing. Mutual funds are easy to buy and easy to understand. They typically have a low minimum investments and they are traded only once per day at the closing net asset value. This eliminates price fluctuation throughout the day and various arbitrage opportunities that day traders practice. Of course, like other investments we have reviewed in this channel, mutual funds have their own disadvantages or risks, call it the way you like it. Those are high fees. One issue many holders of mutual funds face today is high fees. While mutual funds do quite a bit to help their investors, fees can be excessive in some cases. Some mutual funds have expense ratios of 1% or more. We will talk about expense ratios later on this video and explain what they mean. Anyway, 1% may not sound like a big percentage, but it can cost some investors tens or even hundreds of thousands of dollars in their lifetimes. On top of that, the broker may charge you to buy or sell the fund, and some fund companies even hit you with a commission that could be 1 or 2% of the total investment, or what's called a sales load. Luckily, there are many index funds available with very low fees or no fees at all, allowing investors to build portfolios with a few funds for a very low cost, but you need to look for them. Second, taxes. Investors don't have to worry about buying and selling securities all the time when they invest in mutual funds. That usually means a lot less work is needed from the average investor. But when a mutual fund sells securities from its portfolio, it may lead to a year-end distribution to investors. These distributions are taxable investment income. They are taxed at either ordinary income rates or capital gain rates depending on how long the fund held an investment, which mean you might be left with a higher than expected tax bill at the end of the year. Last, no intraday trading. Unlike stocks and ETFs, mutual funds are only traded once per day. That happens after the market closes at 4 p.m. Eastern Time. While this is not a huge problem for passive investors, it could mean there's a different order price than you expect if you place orders manually. An additional disadvantage for me and many others is that you have no control over the fund. So if you're that type of a person, mutual funds may not be for you. There are different types of mutual funds you can invest in. Most mutual funds fall into one of the four main categories: money market funds, bond funds, stock funds, and target date funds. Each type has different features, risk, and rewards. Let's have a look at them. The money market funds have relatively low risks. By law, they can invest only in certain high-quality short-term investments issued by US corporations and federal, state, and local governments. The bond funds have higher risk than money market funds because they typically aim to produce high returns. Because there are many different types of bonds, the risks and rewards of bond funds can vary dramatically. The stock funds invest in corporate stocks. Keep in mind that not all stock funds are the same. Some examples are the growth funds, which focuses on stocks that may not pay a regular dividend but have potential for above average financial gains. Income funds, which invest in stocks that pay a regular dividend and are actually very popular. Index funds that track a particular market index such as the Standard and Poor's 500 index, or you have the sector funds which specialize in particular industry segments like utilities, financials, and so on. Last, the target date funds, which hold a mix of stocks, bonds, and other investments. Over time, the mix gradually shifts according to the fund's strategy. Target date funds, sometimes known as life cycle funds, are designed for individuals with particular retirement dates in mind. Now that I have explained what mutual funds are, their benefits and risks, and the types you will encounter in the market, let's have a look on some actual mutual funds so you can get familiar with what you will encounter, plus how to read them. I am on the Vanguard's website and I will browse through a mutual fund. The one that I have selected is the Vanguard 500 Index Fund. Next to the name, you could see the management style, asset class, category, risk, expense ratio, year-to-today returns, minimum investment, and the NAV price. Let's dive in and explain what each one of them means. I choose Vanguard because they have a very nice interface and I really like the way they provide their info. So, we can see the management style of the mutual fund is index. Index investing is a passive strategy that attempts to track the performance of a broad market index such as this one, the S&P 500. The inception date was November 13 of 2000, about 22 years ago, and the year-to-date performance is negative 21.63%. That's actually for the current year. As you know, the stock market is in a free fall, so as we mentioned earlier, mutual funds can also lose money, and here it is. If you invest in the beginning of the year, you're about 21% down right now. Vanguard provides a nice product summary, and we also get information such as the minimum price to invest, which is $3,000 for this particular mutual fund. Currently, one share costs $342.14. A very important number to pay attention here is the expense ratio. Expense ratio, which is expressed as a percentage, are fees charged to investors to cover a fund operating costs. They are deducted from dividend and capital gains distributions, not the principal. In general, the lower the expense ratio, the better it is for the investors. Actively managed funds will typically come with higher expense ratios, some of them above 1%, and the amount of expense will also be very depending on the fund strategy or asset class focus. The ratio for this mutual fund is 0.04%, which is considered low, but keep in mind this is a passive management style, which always tends to be lower. Moving on to performance, we can check how the fund performed over the years, and in general it had a solid year-over-year returns in par with S&P 500. On the price tab you can see the current value, the change, 52 weeks high and low, plus the historic price for up to 10 years. Now, an extremely important parameter to pay attention prior buying a mutual fund is its portfolio composition. The Vanguard 500 index fund is composed of 503 different stocks, with a median market cap of 165.8 billion, all large cap stocks. The average annual return of growth in earnings over the past 5 years for the stocks in this portfolio is 20.1%. Price to earning ratio is 19.8 and price to book value is 3.7. If you're not familiar with price to earning and price to book value, check my previous video about the different types of stock in which I explain what each one means, plus their importance determining value stocks. Anyway, other stats are provided here as well, such as return on equity, which is the amount expressed as a percentage, and on a company's common stock investment for a specific time frame. Basically, it tells shareholders how effectively their money is being utilized, and last, the fund's total net assets. If you scroll down, you can see what percentage of stocks on the funds are in each sector. Once more, if you're not familiar with the sectors, watch my video about the stock sectors, totally worth learning about them. Scrolling further, you can see how many shares of each particular stock the fund holds. For example, 345.6 million shares of Apple are held by this mutual fund. Every share they own is here, which is one of the main reasons for someone to like mutual fund. They are very transparent. Another important part to check is the distributions, and here you can see the dividends that were paid out, which are being reinvested. The last dividend payment was at the end of June of 2022, and it was for $1.43. At the end of the table, you can see at which price it was reinvested back to the mutual fund. The final part of the review is the fund management. You can see the portfolio manager, the prospectus, and the reports. Basically, all you need to know about a mutual fund can be found in this page. Like Vanguard, there are other financial websites that offer the same information. Mutual funds are an option for many investors, very popular among the younger generation, believe it or not, as well as with employees and employers, as many 401k programs are heavily invested in mutual funds. To invest in a mutual fund, you will need to have an account with a brokerage like E-Trade, Webull, Fidelity, TD Ameritrade, and so on. Just make sure you go over the key points we mentioned in this video prior to investing. I hope that this video shed some light to the mutual funds, what they are, their types, benefits and risks, and the key factors to focus prior to investing in them. I will make more videos about investing, so make sure you hit the subscribe button, and of course if you like the video, please smash the like button, it will mean a lot. Thank you for watching, see you in the next video.